last, so repeat, okay? I won't mind. Now, how issuing the bond at discount going to be reported on the balance sheet? So on the balance sheet, it will be reported under long-term liabilities. How? We will write down bond payable and discount is a minus term here, and this is the value, right? So this is just the accounting equation, how accounting equation is balanced. So see, accounting equation is balanced. Asset increased by 96, cash increased by 96149, liability increased by 1000, and liability decreased by 3851. Net effect is same. Right hand side is equal to left hand side. Now, because of two interest rate, our interest expense and our interest payment is going to be different. Right? So interest payment is based on coupon, because that is what our liability to pay. Liability to pay is 9% or 4.5% semi-annually. But interest expense is going to be calculated based on market. How much actual cash going out from our pocket based on our coupon interest rate. But what is our expense? Interest rate. What is our interest expense? It is based on market interest rate. So interest payment is different. Interest expense is different. So interest payment is going to be simple. 100,000 multiplied by 9% multiplied by 6 by 12, or just 9% divided by 2. Answer is 4,500. That is a payment, cash payment that is going out from our pocket, that those who hold this bond will receive after 6 months 4,500. But what is expense? Expense is interest expense is, let me clear this mess. So interest expense is $96. What is the price of the bond, which is market price of the bond multiplied by the market rate. 10% multiplied by semi-annually, so 6 by 12. So did you notice something? Interest expense is greater than interest payment. Right? Interest expense is greater than interest payment. So whenever there is a discount case, so remember that your interest expense that will go to income statement will be greater than the interest payment, which is actual cash payment. Because interest expense based on the market interest rate. Let me clear this math. So everyone understand this kind of stuff. Whenever it is issued on discount, interest expense is greater than interest payment. Understand? So now what will be our entry? Okay, first of all, what will be the next, you can say, next interest expense after 6 months? So we have amortization table here. So here we go. Remember what we have learned in our this slide. Now I think I should make you see this slide, which we already discuss here. So we are right now learning discount. So remember, it is issued below the par or face value, right? Discount 96, 149, right? It has a debit balance. Discount has a debit balance. We just saw that. And remember, market price increases towards maturity. So this 96,000 after 5 years will go to 100,000, right? So it means on our balance sheet side, bond payable price started to increase because after 5 years, bond payable must be increased to 100,000. So the difference between interest payment and interest expense gonna be added here. Added. So discount gonna be added on each interest expense. So let's go back to our calculation. How much we are going to add back our discount? We have amortization table, and in amortization table, we are going to make that one amortization table. How? Here we go. So our right now the bond value is 96,149, which is the carrying value or book value of the bond in our books, in our balance sheet. And this is the discount, 3851. So remember, our interest payment is 4,500, 4,500, 4,500. Why? Because that is the stated interest rate that we have to pay, and stated interest rate will be on stated or printed value of the bond or face value of the bond or maturity value of the bond, 1,000 or more than 1,000. So 4.5% is coming from because it is on semi-annually. So that's why we have 4.5%. So it is 9% and now it is here for 4.5% because in twice a year you will be receiving 9% in twice a year. Means half in first interest expense is coming from carrying value multiplied by the difference. 307 will be added to discount here. Not sorry, will be added to carrying value here. Value has increased. And how much your discount now left? 851. Answer gonna be 3544. Guys, pay very close attention here. 3544. The difference between interest expense and interest payment is called the discount amortized, right? This will be added to the carrying value 96,149 plus this 307. Answer gonna be 96,456, and discount will be back to will be less from the difference here between interest expense and interest payment. Now the second part, how we calculate the second one, which is here. So we pay again, promised payment is 4,500, and now our carrying value is 96. Can you hear me properly, everyone?
Yes.
Okay. Now let me remove this mess here. Now our book value is 965,456 multiplied by 5%. Answer gonna be 4823. So interest expense, you see, greater than interest payment. Difference is we add on book value and less from discount. So look, which we talk about that market price of the bond increases toward maturity value. It means this discount will be eventually zero, and all the discount going to be added in the bond payable. So remember, this last one is a plug figure here. Right? So where this 4961 is coming from, if you multiply 99539 multiplied by 0.05, it is 4976. So if you less from 4500, answer going to be 476. But if you add 476 in previous carrying value, which is 99539, is going to be more than the bond payable value. So we will decrease it. So similarly, like in our accelerated depreciation, the last is the balancing value. The same here, the last gonna be the balancing value here. So you multiply it, answer gonna be 4976. So if you less than, is gonna be 476. You add it to 99539. It's gonna be 10015. So $15 you just less from here. Answer gonna be 4961. Simple. Rounding effect. Right? So you need to be very careful finding out the last interest payment. Because at the end, we must decreases the discount to zero and make our bond payable to par or face value. Right? Now everyone understand that? Harry?
Yeah.
Marilyn?
Yes, sir.
Nam?
Yes, sir.
Pinyo?
Yeah.
Good. So how we are going to record it? Simple. It's already given how we calculate this one, market interest rate with preceding value here. Discount is amortized, right? The difference is discount amortized, and it will be added to our. So the last value is the balancing figure here. Okay. So what happened to discount? Discount is decreases to zero, will be added to bonds carrying value, so that bonds will eventually go towards its maturity value, 100,000. Simple. We already discussed these slides. So see, if bonds are issued on discount is going to be at the time of maturity. Discount is going to be amortized. So interest expense is higher than interest payment.